Hi everyone, hope you're all doing well. Today I'm going to talk to you about a new stock I have bought. So I bought this stock a couple of weeks ago, but I'm going to update you guys now on the YouTube channel. And this stock is a turnaround play. So I'm looking at a stock that has been crushed on the share price. Financially, maybe a little bit underperforming. And I think that potentially the stock has got to that low of a value now that it could potentially be a good opportunity to buy in, and also the financials could improve in the coming few years and I make a good return on it. I have done this before. It's one of my favourite things to do actually on the UK market, is look for some stocks that are really beaten down, probably too beaten down, and the sell-off has been overdone, and I can ride the wave up as the financials improve and the share price has just gotten a little bit too sold off. Something kind of similar to what I did with Card Factory a few years ago, and Moonpig as well, Revolution Beauty. There's a few stocks that I've done this with, so hopefully this is kind of the next one in here. So hope you enjoyed the video. Let's get started. And as always, if you want to know what I'm buying and selling in real time, the place to be is on the Patreon. So you guys on the Patreon knew about this a couple of weeks ago. So you get my live buy and sell alerts on there, as well as that you get 2 exclusive videos a week. You get a Discord with 500 members onto to talk about stocks, including me, and it's all £5 a month. So it's not too bad at all. It's why it's the highest Patreon to subscribers out there on the whole stock market YouTube scene. And as well as that, a little bit of a shout out, I am going to try get a TikTok going a little bit. There was one a while ago, but a long story short, basically I don't have the password for the old TikTok account now. So it's jkr.investing, and I'm just going to try throw a couple of clips on there every so often. So if you could, go give that a little follow as well today. But getting onto this stock, and it's not Team 17, I just thought I'd let you know that I did sell my Team 17 to fund this position. So Team 17 was a stock I bought. I was only up a couple of percent on this position. It was a relatively new position. Decided to sell this out to move it into this stock, which I thought was a better opportunity. So I thought I'd just let you know that that's where the money came from. I am still trying to build up a cash balance. I want to get up to a 10% cash balance. So one of the main things for buying this stock is moving the money from Team 17 into this business, and then I don't have to fund new cash into it. And I also think the new turnaround stock will outperform Team 17. There were also some other couple of reasons why, but I don't want to make this video on the reason why I sold Team 17 unless you want a full video on that. Knowing my luck though, Team 17 is going to release its full year results next week. So in typical fashion, I bet the stock goes up next week when they bring these results out on the 16th of April. So you can come back and laugh at me on this video in a couple of days' time. But the stock that I did buy with the money that I sold from Team 17 was Watches of Switzerland. I did buy into Watches of Switzerland. Now I am up a little bit on this position since buying, but I thought I'd buy a starter position, and if the stock does go down from here, ideally £3.25, the £3 range would be very interesting. If it does go lower and lower, I can then buy in a bit more. So I've got about another double the position size potentially in this one. And I think with the weakness around the luxury market at the moment, we've seen so many luxury brands struggling. I think Watches of Switzerland could have another bad update in them, or maybe a second bad update in them. So I might get the opportunity to buy it cheaper, and that's what I'm kind of waiting for. So I bought a starter position now, and then I'm going to see if it does go a little bit lower, and then I can buy a few more shares. But as you can see here, when I mean about a turnaround play, the stock has absolutely suffered on the share price. Since its peak in 2021, the stock is down 73%, and that actually does mean that from the 17th of January 2020, before the whole COVID situation on the share price point of view, the stock is basically down from around about 4 years ago, which is scary to see, because when you do look at the financial growth of this business from 4 years ago, the company was doing about 800 million in revenue. It's now doing 1.5 billion. And if you look from a profitability point of view, it was a company losing around 6 million a year. It's now doing 104 million in profitability. So the company has improved massive since that time frame before 2020. Yet the share price is slightly lower, which is unbelievable to see. Now it's an 865 million market cap, trading at 8 times earnings. Now, I've got to say the profitability is going to drop slightly on this one at the moment. Once again, linking around to that this is a turnaround play. It's actually going to be around 11 times earnings, which still I don't think is that bad for this business. Now, Watches of Switzerland is a British retailer of Swiss watches with around 16 stores in the UK. They also own a couple of other brands as well, like Goldsmiths, for example, and I'm sure you've seen them on the high street. And a lot of the revenue from Watches of Switzerland actually comes from Rolex. They are official retailer of Rolex. Rolex is not a public company, and also they do not sell their watches directly to consumers. They use partners like Watches of Switzerland to sell their watches. So historically, the only way you could really own any shares in Rolex is by owning someone like Watches of Switzerland, for example. Now let's get on to, first of all, why the share price is down, because obviously when the stock is down 73%, there's something going on with the business that the market doesn't like. So the first thing is the obvious one, Rolex and Baccarat. I hope I said that correctly. So basically Rolex went and bought them, which worried a lot of shareholders of Watches of Switzerland, because Rolex normally just sold it to the sellers, and sellers like Watches of Switzerland will go sell the Rolex watches. But now they've actually bought a retailer of their watches, people are thinking, are they going to limit their supply to someone like Watches of Switzerland when they've got someone like who they could send it to straight away and they make more revenue on it? So people are worried about if Rolex are going to limit their supply to Watches of Switzerland. And when Watches of Switzerland revenue, a good 50% comes from Rolex, that's what everyone's kind of worried about. Now, since then, Rolex have said, we only made this acquisition because we didn't want to go into private equity hands. And also the CEO of the company was going to be retiring and there was no one to pass the business on to. So it made sense for us to go buy it because we wanted to keep up that good relationship. So Rolex have basically come out and said, this will not change our supply to someone like Watches of Switzerland at all. However, even with them saying that, I've got to say, when 50% of your revenue comes from one brand, you've always got to have that back in the back of your mind. And that's why I will be keeping this a relatively smaller position, because of the risk of that if Rolex was ever to turn around to Watches of Switzerland and pull the plug on them, it would be a major impact for them. So there is that to keep into consideration, but at the moment, Rolex said they will not limit the supply to Watches of Switzerland at the moment. The other thing is the interest rates, the economy. We've seen higher interest rates coming up, we've seen the economy slow down, and people in general have gone and bought less luxury goods. The middle class that sometimes maybe push into buying something like a Rolex are being a little bit more cautious about the spending, and that's also gone and impacted someone like a Watches of Switzerland. And that led them to do a profit warning. They did the profit warning on 18th of January. So the stock really started falling from the news on the Rolex acquisition. And then also we had a profit warning, and that's led the share price to fall this much. Now I do think Watches of Switzerland could potentially have another profit warning in them, and I'll make you aware of that one as this weak environment does continue. And also when I look at the watches market overall, it has been really weak. This is a watch index value, and you can see here we really peaked in 2022 after a big rally in 2021. Why did we have such a big rally? So many people had so much free cash because of the COVID situation, and people were buying luxury goods, interest rates are very low. And then really since the whole Russia-Ukraine situation, we saw the economy start deteriorating, interest rates going up, people were spending less free cash. And that has also affected the prices of watches, as you can see here. However, if you do look at this chart here, you can see that the price of watches is starting to make a bit of a U shape here. It does seem to be stabilizing in the last couple of months, which is one of the big things that I look at and go, okay, we're starting to see the stabilization, maybe the bottom of this watch market starting to creep in. We might get another profit warning for the next coming few months, but the economy is starting to improve, interest rates are starting to be cut, and it seems like we are towards maybe a bottom, and that would also lead to probably a bottom in the share price of Watches of Switzerland. And you can see here, historically, even though we are having a bit of a dip here, and you would expect that in the time frame that we're in, when you look at the price of watches and Rolexes, historically they are good performers. Rolex watches do continue to go up in value, and you can see here the historic performance of them. And even when we do have little dips, as you can see here during the 2020 period, historically we do recover them and we go up. So that gives me confidence if I am holding this for a longer term. The value of watches will come back, and historically they do go up over time. Now let's get on to some of the positives here as well. When we look at Watches of Switzerland, they have performed very well. They have expanded massively, and that has increased in revenue and profit performance. Now, what they've also done is they've now set out a longer term game plan. And if you actually look at the longer term game plan that they put out only a few months ago on the 7th of November, they are now aiming to double their sales and profits by financial year 28. And the big thing they're going to do that is by expanding into the US. Now, they're also going to be moving more into their Rolex certificated pre-owned program, which I also think will probably give them better margins, because if you're selling directly from Rolex, I'm sure there's quite thin profit margins to make. If you are buying from someone else and then selling on, you'll probably be able to control your profit margins by buying them cheaper and selling them on for more money. So this is probably going to be a very good expansion as they move into more pre-owned watches. As well as that, the US growth is going to be probably a big part of the driver, so they're going to expand more into the US by opening up more stores. The US is a stronger economy as well, and they are going to try and grow their business in the US since they entered in 2017 by opening up venues in like the Wynn, for example, and that revenue has grown at a CAGR of 40%. So yeah, I really like the expansion that they're going to do into the US market. That's forecast to be their fastest growing market in the next few years. And even if they don't do these numbers they're forecasting, even if they do half of these numbers they're forecasting, I actually think from the share price with the current values, it will still be very good on a share price performance basis. And even if you look at the recent update, sure, the profitability was down a little bit, the revenue on a constant currency basis was down slightly, but when you look at the business from a geography point of view, if they're focused on growing the US, this is actually still doing okay for them. If you look at the US growth at the moment, it was up 8% on a constant currency and 3% on a reported basis. So during this period of time of this weakness, the US is actually still performing very well. The weak part of the business at the moment is the UK and Europe. That was actually down 7% at the moment. And obviously the reason why is because Europe is being hurt a lot more because the economy isn't performing. And that comes back to my point once again, is that if we do have a rebound in the economy, when we see the interest rates cut, I think watches sales go back to historically performing how they used to do, and they start going up in value. So really from a US point of view, the US business is still doing okay. It's the UK and Europe business that's actually being the weak performing businesses. And as soon as the economy starts turning, I think we start going up and the share price goes back performing very well. And if they keep focused on the US market, which is the part of the market that's still doing very well, the company has a pretty good future. Even if it doesn't get close to the long-term targets, even if it does half of this, it's still going to do very well. And when you look at Watches of Switzerland's numbers, yeah, the revenue is flat as we've seen here because of the weak growth in Europe and UK. But if it starts going up to, unless they're forecasting nearly 10% growth here, even if it does only 3%, 4% growth, I still think this is pretty impressive at this valuation. And from a profitability point of view, we're going to see the profitability go down from about 117 million and we're going to go down to about 88 million in profitability. That's still good amounts of profitability. And then if we do start seeing the rebound in 2025, analysts are forecasting 95 million. That's not a bad valuation when you look at where the company is and if we start going back up to growth. And like I said, we're still throwing off good amounts of profitability. If we get to about 100 million in profitability, when you look at the balance sheet of the business, the company's in a really healthy place. They sit on 13% debt to equity, 68 million in debt. The balance sheet has improved massively over the last few years. And if you look at the balance sheet, they're going to be able to pay the debt off in 1 year's profitability here, which is very good. And like I said, 100 million in profitability. When you're doing, if you're at 893 million market cap and you do 100 million profitability, you've got so many options there. You'll be able to pay off the debt. You'll be able to maybe even put a dividend out there. You could buy back shares. I mean, if they do 100 million profitability, they could probably nearly buy 10% of the market cap nearly in 1 year, which is a very good option. So the company's throwing off that much, even if the profit has downgraded slightly here, which is, by the way, is priced in now. And even if it doesn't get any worse and it stays down here, the profitability options they're going to have is going to be very good for the business. As well as that, there has been some insider buying going on inside the business. There was 2 buys at September time, around £5. Obviously, it's fallen even lower then. There was the chairman of the board. He did pick some shares up as well. He bought 186k worth of shares, which is a pretty decent buy. And he bought them at £3.91. Now, obviously, the thing with the share price is that it's down at £3.59, so the shares have even fallen lower since the chairman's big buy there. And then when you look at the PE history, this company was trading at 42 times earnings in 2021. Now, obviously, valuations went absolutely crazy during that time period, but even during 2022, during the crash, the company was trading around 17, 18 times earnings, which I think the company will go back to that sort of levels. So if this is the bottom of the company or the financials and they do start improving and we start doing 80, 90, 100 million in profitability in the next few years and we start trading this company more towards 17 times earnings, there is plenty of upside here in the business. And that's what makes me think that it's potentially an opportunity to be looking at. Now, like I did say, there is chance that this could get worse. We are nowhere near the bottom of the economic cycle in the next few months. There's still the interest rates situation. Are they going to start getting cut? So there is potential this stock has another tough 3-6 months. And I do think the stock has the potential to maybe drop another 10-20% from here. And I am leaving room for that to happen. And I can average down a little bit more. But when I start looking at the turnarounds and how much is priced in here, I don't know how much worse it can get for them. And when I look at the risk to reward of the longer term growth plan, the valuation is right now, you're still picking, at the end of the day, you're still picking up a profitable company that's going to throw off probably 88 million in profitability. And I think that's pretty fairly valued to where it is right now. And if they do start going back to growth, I actually think that's very attractively undervalued. And if they get anywhere near their long-term growth plan, I do think I see a good turnaround play starting to emerge here. So I do decide to buy a position into Watches of Switzerland. I will see if there's another profit warning in this, and that may be giving me an opportunity to buy lower. But I think we are starting to see the green shoots. We're starting to see the U-shape, the bottom of what seems like the U-shaped recovery starting to appear here. And I think it's time where I'm willing to kind of take a starter position in this one. And that's what I did. So yeah, I did buy a new position in a turnaround play of Watches in Switzerland. Like I said, there is still the risk element of the Rolex situation when, you know, a supplier makes up that much of your revenue. That is the big reason why I'm going to keep it a smaller position. But I am starting to see some green shoots here after what's been a horrible 2 years for this business. And if they do get anywhere near that long-term game plan and the profitability they still throw off and the balance sheet, I think it's worth a shot here, and I'm going to go for it. I think the risk to reward is definitely favourable in this situation. So yeah, hope you enjoy the Friday video, guys. I don't know if I'm going to make a video on Saturday or Sunday, so the next time you see me might be Monday anyway. So I hope you enjoyed the video, and I'll see you in a bit.